Welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeeze setups. Today, we're putting a unique microcap company under the microscope, one that's showing an incredibly high cost to borrow. Before we jump in, please remember this important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show company logo/ticker GITS. Today's focus is on GITS, ticker GITS. This company has landed on our hard-to-borrow screener due to some striking metrics. GITS operates as a micro-cap company, and while no specific sector information is readily available, its market capitalization places it firmly in the smaller end of the market. What makes GITS particularly interesting from a short squeeze perspective is its estimated float, which stands at a relatively small 2.4 million shares. However, it's crucial to note the recent trading activity. GITS has seen 0.0% change today, over the last 5 days, and the last 30 days. Similarly, today's volume stands at 0 shares, with a 30-day average volume of 0 shares, resulting in a relative volume of 0x average. This means the stock is currently not experiencing any active trading. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB, and why is it so important for short squeeze potential? When an investor wants to short a stock, they need to borrow shares from a broker first. Think of it like renting a car. You pay a daily fee. The cost to borrow is this fee, usually expressed as an annualized percentage. When many people want to short a stock, or when there are very few shares available to lend out, the rental fee, or CTB, skyrockets. These can easily exceed 100% or even several 100% annually, as we'll see with GITS. A high CTB indicates that there's significant demand to short this stock, or a severe scarcity of shares available to borrow, putting pressure on existing short sellers. Why this stock is hard to borrow right now. Now let's talk about GITS specifically. Our screener flagged GITS with an eye-popping annualized cost to borrow fee of 932.3%. This is an extremely high number and signals that GITS is exceptionally hard and expensive to short right now. We don't have data on CTB momentum or the exact number of shares currently available to borrow, but this 932.3% figure alone is a red flag for short sellers. Combined with this estimated float of just 2.4 million shares, this high CTB suggests that the supply of shares for shorting is incredibly tight. Our internal composite squeeze score for GITS currently sits at 42.5 out of 100, which indicates a moderate level of squeeze potential based on these metrics despite the current lack of trading activity. Squeeze mechanics explained. For those new to the concept, a short squeeze occurs when the price of a shorted stock rapidly increases, forcing short sellers to buy back shares to close their positions. Short sellers initially profit when a stock's price falls. But if the stock price moves against them, especially if it climbs rapidly, they start losing money. When borrowing fees like GITS' 932.3% CTB are high, and the supply of shares to borrow shrinks, the pressure intensifies. Short sellers, facing mounting losses and high daily interest payments, may be forced to cover their shorts by buying shares in the open market. This sudden demand to buy can create a chain reaction, pushing the price even higher, which in turn forces more short sellers to cover, exacerbating the squeeze. It's crucial to understand, however, that a high CTB does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock will eventually fall, and they are willing to pay a premium to maintain their short positions. Dilution risk check. An important factor to consider in any short squeeze thesis is dilution risk. Dilution happens when a company issues new shares, increasing the total share count and often lowering the value of existing shares. Even with a high cost to borrow, significant dilution can flood the market with new shares, providing an easy exit for short sellers and effectively neutralizing any squeeze potential. We performed a thorough check for GITS. We found no recent dilutive SEC filings such as -1s, -3s, or 424Bs in the last 90 days. Furthermore, there have been no recent reverse splits reported for GITS in our look-back window. This means that, based on current public filings, GITS does not appear to present an immediate dilution risk that would directly counteract a squeeze scenario. Let's take a quick moment for another important reminder. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given GITS's current state of zero volume and no price movement, any potential squeeze scenario would first require a catalyst to bring the stock back to life. Show blank chart, then imagine volume spike. Key things to watch for would be a sudden surge in trading volume, indicating renewed investor interest or news. Accompanying that, we look for significant price movement to the upside. Continued tightness in the borrower market, ideally with available shares to borrow diminishing even further, would add fuel to a potential squeeze. While CTB momentum is not available for GITS, any future reporting of a sustained high or increasing CTB would be another data point to monitor. For GITS, the most important initial signal would simply be any activity whatsoever breaking its current dormancy. Its presence an intriguing case with its microcap status, small 2.4 million share float, and an exceptionally high 932.3% annualized cost to borrow. While these are compelling metrics for a short squeeze watch, the current complete lack of trading volume and price action means it remains a purely speculative setup, awaiting a spark. No immediate dilution risk is a positive, but always remember the balanced perspective. High CTB alone doesn't guarantee a squeeze. What are your thoughts on GITS and its hard to borrow status? Let us know in the comments below. If you found this analysis helpful, please hit that like button, subscribe to the channel for more unique insights, and share this video with anyone interested in understanding the mechanics of short squeezes.